Good morning, everybody, and thanks for watching. I'm working more today on my stock market tool, and I'm digging into the portfolio strategy. So I'm going to start paper trading Tuesday morning. Today's Sunday, so I'm going to dig into the portfolio strategy a little bit. And I've been working on improving it, but I need to dig into it a bit. So I've found there's a few different models and portfolio strategies that are working. So at the top are the different models I'm going to try. And then at the left side here are the different portfolio strategies I want to try. And so this is going to give me 36 total implementations. Now, if I'm running 36 different strategies, there's going to be a fair amount of infrastructure I need to set up to automate this. I don't want to run each strategy individually and pull the picks for the day. That'll take a couple hours every day. So rather than taking a couple hours every day, I just want to run a script that's going to update the code and put all of the positions in a nice format. So rather than do all of that to start with, I'm just going to focus on a single strategy, model and portfolio strategy. And then from that, I'm going to build that out. And so in the next couple weeks or so, I'll build this out to be all of the models. But for now, I'm just testing the single model. So um, now I was looking into that yesterday, and I was looking at basically different. I'm trying to use different parameters for a single model to find what works best. And so here I'm looking at the max drawdown duration, Sharpe ratio, and annual return. Um, Using only a volatility scaler on the portfolio and changing around, keeping the volatility target at constant at 8%. Um, and then changing around how long the look back is. So you can also see this is more data here. And so you see generally if I'm increasing the volatility threshold, the drawdown's increasing. And that makes sense. Um, uh, but that's not the case for the returns. The returns increase with a higher volatility threshold as well. So I'm kind of looking through here and trying to see is there any optimal value that I can use. And there's nothing that's really performing best. Best seems to be this 20-day look back at 12% volatility threshold, but um, yeah, like I said, it's hard to draw any conclusions. So um, it seems like there's some optimum range in here. Up here, the forest green line is the 10-day look back. These light green dots are a 5-day look back. This purple line is 15-day look back, and this orange line is a 40-day look back. So both below and above 20 days, we're getting up here. At 20 and 30 days, we're getting down here. So there's some optimal look back value to use. So I was looking at that. But also what it could be is there might be better ways to scale the volatility. So I'll be looking into that today. So before I get into it, let me go over the whole project, what my goals are for the project, um, and exactly where I'm at right now. So um, this is the goals. Oh, wrong PowerPoint, sorry. Um, These are the goals for the project. So I have two goals. My first goal is to beat the S&P 500 by a significant margin. So the S&P goes up on average 6% per year. I want to do 3 to 4 times better than that and get 18 to 24% per year. With the caveat that I want to stay market neutral. So the strategy shouldn't care if the market's going up or going down. Regardless of what's happening in the market as a whole, the strategy should reliably return money every month. Now, I have a secondary goal. I'm writing all this code in Python, so my secondary goal is to generalize the code and make it so that it's a flexible tool that anyone can use to create all sorts of different machine learning models for themselves. So this is the layout. You isolate a universe of stock data, then use that universe to train a returns model. Once you have a good returns model, you're implementing a portfolio strategy. I'm basically done with this for a single strategy. I've gotten up to something that works well. And you can implement all of this in under 100 lines of code. So if you're interested in that, go check out the GitHub repository. The link's in the description. Download it, fork it, let me know how I can improve it and what you'd like to see. If there's anything you'd like to see changed, if you'd like to see some features added, whatever, just let me know. So yeah. Now, yeah, so I was looking through it, optimizing the portfolio. I was trying a bunch of different things. What did I do here? So this is with a 25-day look back, 8% volatility. Now the most recent one I ran was 27-day look back, 8% volatility. Yeah, so good. Did I put that into the data? Yeah, so that's that point, 25. So let's try 27. Actually, I just ran 27, so let me put that onto the slide. I don't know which one I ran. Oh, that's the optimization. Oh yeah, I was running that last night, so that'll be also interesting to look at. Alright, so this is from the back test. Just make sure, so it's not there, could be there. This was a model that trained. So yeah, it must be this one. Okay, so now let's try 23. See if that does any better. Alright, so now we're running that one for 23. So let's put that in the PowerPoint. Simple strat, 5 longs, shorts, 1 day rebalance. Alright, so let's copy this and put it in here. So this is optimized strat, 5 longs and shorts. Trained through end of 2020, optimized through end of 2025. Okay, and so let's screenshot this and put it in so we can change it. So Okay, so that's the name of the strategy. All right, so here are the results. All right, so let's put that in here. So now we have 28. Was that 28? This guy's 23. This guy's 27. So now we also have 27 and 23. So 23 was the one that just ran. We have drawdown 28.15. Return 22.53. So how are we on return? Oh, so local minimum in return. Or sorry, local max in return. Sharp ratio 1.14. Drawdown duration 463 days. Yeah. All right, now for 27 is up here. We had a drawdown of 29.34. Annual return 21.29. Sharp 1.0689. Drawdown duration 493 days. So 23 gives the second highest return. The highest Sharp ratio. And close to the lowest drawdown. So, hey, Night Archives. Thank you. I appreciate it. So 23. I guess I could just try 22. Thank you, Night Archives. So what was that? 23. So I guess let's put that guy in. So I'll probably want to try some more. Let's put this in. Alright, next we can try 22, 23, 24. And then let's try that optimized portfolio. So it's using spread and IC scaling with 50-day look backs. Volatility, it's using a 25-day look back. So this was 22, right? Yeah, 22-day look back. Max drawdown was 28.26. So a little bit higher. Annual return 22.77. Sharp 1.1355. Drawdown duration 494 days. So we're still getting a high sharp. So I think that means it's somewhere around there. Yeah, let's just do 24 for consistency, and then I'll be done with that. So let's run it again. Screenshot this. So what's it do for the drawdown? Oh, I took the drawdown off. Buffer multipliers 3. Alright, I'll be right back. I gotta go to the bathroom. Yes, I'll explain that as soon as I come back. I just gotta go pee real quick, and I'll be right back. Okay, so to answer the question, how did I make this? Let me go through um, the PowerPoint. So I'm tracking everything in this big grand PowerPoint. There are 250 slides, so lots of stuff I've been tracking. This is what I've been doing. I started this at the end of last year, December 27th, and I just want to automate some strategy to make money in the market. I've tried this a bunch of different times and I never carry through with the project. So I thought, with YouTube live streaming, this will help be an external motivator. This will help me get the project done. It'll give me motivation to work on it every day. And that's kind of been working. Also, all the people who tune in, people help. They give me tips. They give me clues. They help inspire me, like you. Earlier, you said, I'm doing great. Keep going. That stuff helps me out. So, I started out with this. I just wanted to I started with some very basic things, combining returns for different stocks. And this is all kind of qualitative, so I wanted to automate things. So here I started looking at sort of variables to look at, and I made it so I could look at fundamentals. Here I kind of generated the outline for what it should look like. Here I got a better data source, so I had basically I was starting out with data I'm pulling from the NASDAQ. That's not very efficient because you need to download a new CSV for every day. So I found a better data source that has data going back to 2011. I started working on building models. I had some success, but you can see the summary of that here. So basically I did get a model which worked. The model was predicting the probability of going up in a stock. But you see here, first off, if you remember what my recent charts have looked like, this just doesn't look very good, this chart here. And basically this strategy was very fragile. It was only picking one stock per day. And that's not really scalable. You can't implement that at, using a lot of money. So I wanted to go through and try a lot of different models. This is basically the outline for the project. So I'm starting, like I said, I have data going back to 2011. I'm isolating a universe from that data. Then I'm using that universe to train a model. Once I have a model I'm happy with, I'm implementing that into a portfolio strategy and trying to find some good portfolio strategy for it. When I did this, the code base was really a big giant mess, so I had to clean up the code base. And the idea here is just clean everything up so that instead of making a new script every time I want to try a different model, put everything into classes so I can just experiment with the different classes. And so I implemented all of these features and targets, and I've added quite a few more since I made this slide. So I finished this code base restructure at the end of February. I spent March looking through different models, exploring models, trying to see what works well. That's what all this research is. And I kept going. There were all sorts of things I had to fix, all sorts of bugs I had, all sorts of methods I tried to improve the models. And I finally happened at the beginning of April, I finally came upon what I was confident in as a good model, this one. And the reason I think it's good is, one, if you look at the metrics up here in the red box, the top metric, information coefficients, giving the predictive power of the model. The next four are giving the stability of the model. And I'm beating all of the metrics by a significant margin, except for standard deviation of the information coefficient. I want that to be 3 to 13 times the information coefficient, and it's 3 times. It's at the lower end of the range. The lower the better. So this looks really good on all the metrics. But not only that, it looks really good on the decile analysis as well. So the bottom decile is the worst performing, top decile is the best performing, and each decile should be higher than the previous. That's exactly what we see here, which means that it's monotonically increasing. Now this is for a single model, so I was really confident in this when I made a new model for every year from 2016 through 2025. And when I tested it, it was beating my metrics still for every single model that I trained. So these things indicated it was a really good method. I went through and started implementing some portfolio strategies. I found that basically anything I tried on the single model worked really well. But then when I tried it on the full data going from 2016 through the end of 2025, it did really poorly from 2016 through 2022. So the question is, why was that? I looked through and added some more models, updated the model, got better models. Now what I'm working with is the top model here, is the Sharp model. And then I looked at the returns for the different deciles over time. So when I was looking at that, you see here from 2016 through 2019, if you look at the far right chart on this top row, you see in red is the bottom decile, green is the top decile. So you see here actually the bottom decile is significantly outperforming the top decile over the whole time period. And if you did a simple long-short strategy, going long on the top decile and short on the bottom decile, you would have lost money over this time period, 16 to 19. Same thing's the case for 2020 to 2021. But 2022 through 2025, we see the correct behavior. So the top decile is best, bottom decile is worst. So that's basically the reason on the Sharp ratio model, we're going negative in these two regimes, but positive in this last regime. And that's the reason for it, is the spread of the deciles. Is the bottom decile should be performing worse, but in these top two regimes, it's actually performing better. So this model is predicting the Sharp ratio. I did the same thing, but predicted the return, the log return, rather than the Sharp ratio. And you see this is somewhat fixed. So here the bottom decile is still the best performing, but the top decile is right below it. So and here the bottom decile actually by the end of the time period is the worst performing, and top decile is the best performing. And so you see here in these two regimes, a simple long-short strategy would have ended up positive. So and then in this last regime, it did really well. So what I'm going to do is I'm working with this returns model. I don't want to give up on the Sharp ratio model yet. So I'm going to implement both of them, but I'm more confident in this returns model. So the final step is implementing portfolio strategies. So I have, since I want to try these two different models, there's also a lot of different ways to train the models, and there's a lot of different portfolio strategies that you can implement. So at top, these are the models I want to make, and then these are the portfolio strategies I want to implement. And so there's going to be a pair between each model and portfolio strategy, which is these boxes here in yellow. And what I've highlighted here in green is the first strategy that I'm going to implement. So just a simple strategy, model 28, the returns model, trained through the end of 2025. I'm taking 10 longs and 10 shorts, so 20 total positions each day, and rebalancing. This is actually rebalancing every 5 days, so I'm not doing this one. I'm doing a 1-day rebalance. So I'm focusing on implementing this strategy right here is what I'm doing now. And so there's a couple of things actually. I'm focusing on implementing that strategy, so that's what I've been looking through here, trying to find some optimal parameters, and also what I'm looking at here and here. And so the other thing I'm doing, some of these strategies are being optimized. So this is the results of an optimization, which was to optimize this strategy. So I'm going to implement that as well. So another thing is, you see the thing that seems to be most effective is changing around this volatility scaler. So I have a target for the volatility. If the portfolio drops below that target over the last 20 days, then it's raising exposure to try to get closer to the volatility target. If the volatility is above the target volatility, then it's lowering exposure to bring the volatility down. So this is with different look-back windows and different volatility thresholds. And these are basically the curves I get. And so this is a very simple, this is just the rolling volatility. And so there's some more advanced ways of calculating volatility. So today I'm going to finish looking through this model, the manual optimization. I'm going to look at I'm going to do some model optimizations while I work. But then really what I'm doing today is looking into if I incorporate these different volatility calculations, do I improve portfolio performance? So the idea is this is the simplest, what I'm currently using is the simplest volatility calculation. The idea is with something more advanced, I should get something that's more responsive and scales the portfolio better. So that's what I'm working on now. All right, so we got the next look back. So this was with what, a 24-day look back? Okay, and here are the results. Okay, well, thanks for tuning in, Night Archives. Thanks. I will. I'll keep pushing forward every day. Slow. It's a slow slog forward, but I'm working on it. Thanks for the positive attitude. Okay, I need to get some music to listen to. Let me know if you guys have any suggestions. Music suggestions. Alright, let's listen. Alright, now let's put this data in. $24. You too, Night Archives. Max drawdown 27.98. Annual return 22.48. Alright, sharp 1.1381. Drawdown duration 461 days. So yeah, there's basically these three optimal values here. I think I'll use 23, 24, and 25 are all good. '24 had the lowest drawdown though, so maybe I'll go with that. Okay, so now let's make the optimized, set the optimized parameters. Alabama. Alabama. Alright, so HRP look back 120, 5 longs, 5 shorts, right? Yeah. So let's set these. So 5 longs, 5 shorts, hold for 5 days, rebalance every day. HRP look back 120. Smooth, true. Buffer is 3. Cost BPS keep 15. Sizing method, beta neutral. Target volatility 0.02. Volatility look back 25 days. Use IC scaling, true. IC look back is 50 days. IC threshold is minus 0.03. Spread scaling is true. Spread look back 50 days. Spread floor 0.6. Yeah. Alright, so that obviously looks great. Those results are terrific. Oh, but look at the... So the exposure is almost always 0, or very low. The average might be 0.3. So maybe I have the wrong objective when I'm optimizing. Why is this taking so long to think? If your objective rewarded low risk, drawdown magnitude volatility, or anything with a heavy risk penalty, and recall your earlier sweeps were literally, then low exposure isn't a quirk, it's the degenerate global optimum. The cheapest way to minimize drawdown or variance is to not be invested. The optimizer found that turning the strategy mostly off scores best on a loss that doesn't adequately reward being deployed. The use of AI is dangerous, but will surpass it one day. What do you mean? Surpass what? Humans? Alright, so let's think about that. If it's pinned at a floor, it is pinned at a floor. The cap is binding, not the dynamics. Hey, you're still here at Night Archives. Old Pine. By who? Ben Howard? This song? If it's pinned to the floor, the cap is binding, not the dynamics. Hold what matters. What's that mean? Alright, I'm gonna go to the bathroom again real quick. The bullets. The bullets. Stop it crying, it's a sign of the time. Hold What Matters by Jason Gletzohe. Okay. Stop it crying, baby, it'll be alright. Hold What Matters. Gletzohe. Your dynamic scalar is almost certainly computed in 2 steps. All right, so what do I have to do? Diagnose the objective explicitly. Was it scale invariant or risk laden? Compare target volatility to volatility of unscaled strategy. Optimize the signal parameters. Get Sharpe ratios. Add a no trade ban on leverage to cut churn. How do I make this black? Okay, good. So, did I finish documenting that other stuff? No, I didn't document that. But dust cloud, I'm telling you, baby. Things you compare target volatility to volatility of unskilled strategy. So let's put a note in on what I'm working on. Working on model 28. Working on model 28. To you, I'm just a man. To me, you're all I am. Where the hell am I supposed to go? Okay, now let's do a base model with no risk. Or no leveraging. Okay, so let's turn off all scalars. Change this to 1.5. Smooth predictions. HRP look back 120. Yeah. Okay, so let's get into the next thing. So what am I going to call this? Target volatility versus Realized versus target volatility. So there should be no scaling, but it scales down once in 2020. I mean, I kind of already did that. Yeah, but I'd have to see what the exposure is. Need something to listen to. Okay, so we have HRP strategy. Okay, so we should get a volatility chart before getting the results chart. So let's see. Between unscaled volatility, volatility target, and exposure level. Okay, so huge volatility spike there. So I see it's always scaling down because the volatility is always above 15%. So do I need to tolerate more volatility? So it never really goes below 15%. So what if I set it to 25%? So here it would be full exposure. Here it spikes, would drop the exposure. So let's try just setting 25%. So let's set scale to true. What are returns we are getting? Hey, Nick Sahota. Um, I'm not sure what you mean by that. What are returns we are getting? What are the returns of the strategy? So the Iran drop was a much higher volatility spike than the tariff crash. Oh, well, these are the returns in purple. I'm just kind of experimenting with things and trying them out. I tried setting the acceptable volatility higher. Um, yeah. So 20-day look back with 0.25. What's the drawdown percentage? 47.57. Hey. So lower. Okay, I just want to see how this runs. So come on, let's see. So if I set target volatility to 33%, it's mostly staying below that. And what do we get for the drawdown? 53%. So what if I accept more volatility in the optimization? Okay, so 2015 to 2026 is a lot. So let's do 2020 to 2026. Then we'll get that 2020 crash in there. Okay, I'm gonna go to the bathroom real quick. I'll be right back. Oh man, sorry that took longer than I expected. Alright, so what'd we get? Wait, why is this? Oh, this is running the optimization. So we're at 1.1. Oh, best trial is still 1 though, so it's not improving. Let's see. Give it 30 iterations. Okay, now I'm gonna turn off the optimizer. Okay, so now what if we just put the warning at minus 0.2 and lower to half exposure. Obviously kill it if it's like minus, I don't know, that shouldn't trigger. Oh, there we go, 19. We got an improvement, but not much of an improvement. 0.07. So, okay, so what am I looking at now? Relationship between unscaled volatility, volatility target, and exposure. Oh. So I forgot I need to do that. So let's turn off scaling. And let's get these results again, but we want to show the volatility. Hey, Pitt the first. What's your model and architecture? So the model, the core model, the workhorse of everything is the, it's a light gradient boosting method. So basically a tree-based algorithm. It's basically a random forest, but more efficient. And so it's common for stock data. It works well on time series data. It handles a lot of data well. So I have data going back to 2011. So yeah, I forget, what was I saying? So I have data going back to 2011, and therefore, there's a lot of data. It's daily data. So there's, I don't know, there's millions of rows of data that I have. And so, yeah, basically light gradient boosting method works well on that. So that's the workhorse. Let me put this in real quick. I'll format it later. But this is the outline for the strategy. Where is it? Zoom out so you can see. Let me see. Can you see that? Yeah. Basically from that data, from those millions of rows of data, I'm getting a stock universe. So basically high volume stocks. I've isolated it to 3 different types of stocks. So I'm only looking at common stocks, real estate investment trusts, and ADRs, which are foreign stocks listed on the US market. And so I've isolated my universe down to those, taking the top by volume, cutting out everything that's under $5 a share. And then using that, and then I go through the data and update the universe every month with those requirements. So certain things are moving into and out of the universe. Then I create a model. So basically I define features. For instance, Bollinger Bands, or say MACD might be a feature. But I define a bunch of features. I spent a couple months looking through models, finding something that works. And then it's predicting something like returns. So I have one model that's predicting returns over the next 5 days. I have another model that's predicting the Sharpe ratio over the next 5 days. And I'm pretty confident in those models. The metrics are really good. The decile analysis looks really good. And then the walk forward. When I do a walk forward, it's hitting my metrics for every year for both of those models. So I'm going forward with those models. And so I've gotten this done. I've got the returns model. This is the workhorse of the whole strategy. And I'm only using price data. I don't have any fundamental data, but I had a hard time getting that. And I have the requirement that I want all the data I use to be free, because if you see here, the second goal is to create a tool that anyone can use. So I have a GitHub for that. If you're interested, the link is in the description. But basically, I'm generalizing the code structure for this. And then actually making the universe, the model, and then implementing a portfolio strategy. I'm doing all of that in under 100 lines of code. So anyway, yeah, so now I'm up to the point of looking at the portfolio strategies. And basically I'm implementing several scalars. Volatility, let's make sure these are the same. So 47.42. Oh, I didn't run it. What was I saying? Oh, yeah. I have different strategies for scaling down portfolio exposure based on external factors. One is just, the one that I found is most effective is just scaling down based on the volatility of the portfolio itself. And so that's the one that I found is most effective. So I'm looking into that right now. I'm using a pretty simple method, just simple rolling volatility. And so I'm trying to see if I use maybe a more advanced method of calculating volatility, can I get better returns out of the portfolio? So that's what I'm up to right now. So, oh, but that's with target volatility 33. Oh, I didn't run this. So that did lower it. So what if I say target volatility 8%? All right, let's see. Make sure this is saved. Okay, so this will give me, is that? No, that's not what I wanted. That's with, well, I could have put that in here, but whatever. Unscaled volatility, volatility target, and exposure level. Okay, so when I'm plotting, I could just print the... Alright, so back to here. Why does it use a 60-day window? I want a 20-day window. Specifically, actually, I'm working with market manipulation. The spoofing method, I don't even know what that is. I've never heard of that before. Where a trader places large deceptive buy or sell orders with no intention of executing them. These fake orders create a false illusion of market demand or supply, tricking other participants. What? This is what you're looking into? Oh, that's cool. It's a way of battling automated algorithms. That's pretty interesting. So is there this whole like digital warfare space of the automated algorithms and the people who try to break them? That's cool. So how's it going? What are you doing? Where are you at? Are you making something, or you're currently doing the spoofing method? Oh yeah. I need to go back to Explorers. See how the optimization's doing. Best trial is still 19. But we're all the way up at 35, so maybe it's just not improving much. Okay, so let's think. What do we want to do now? What are we doing? Turned off scaling. Oh, I just need to get this for the PowerPoint, right? So volatility of unscaled strategy. Oh, so let's add something in where we print plot, cumulative return. What? 2020 had something crazy happen, but also recent times was crazy too. Okay, so mean volatility, and then we can put in np dot mean of rolling mean min slash max is rolling vol. So np dot min rolling vol slash np dot max rolling vol. Don't want to divide those. All right. That should be good. So here's what it looks like. Huge volatility spikes during the big drawdown. So I think what that means, actually, that makes me hopeful for what I'm trying to do, because there's the huge volatility spike, but let's see, where does that happen? So portfolio goes down, volatility goes up. Oh, because this isn't lagging. So it was up 4%. Oh no, it was up almost 4x. Well, that's a huge drawdown. Oh, I already have that. That's what I wanted, was the volatility, but that's okay. I want to run it again anyway. No, I'm trying to create a model to prevent them. So you're preventing spoofers. So how would that work? You detect a spoofer, and then what do you do? Buy the order? Purchase the order, or what? Fill their order, I mean. Okay, so then we're going to get that here. Then hey NGK, how are you? Wait, what's that? Oh, sports bet. No, I never sports bet for fun anymore. Because they passed the big beautiful bill where you can only write off 90% of your losses. So it used to be you needed to have like a 55% edge and you can make good money sports betting. Now you need you know, increase it by 10%. You need a 65% edge to make good money sports betting. And those are, you know, it used to be when they would talk about having a good edge in sports betting, like 65% was like dream territory. Like there's no way you could get a 65% edge. But 55% edge you certainly could get. But now 55% edge, you're a losing better. All thanks to the big beautiful bill. So no, I never sports bet for fun. When was the last time I bet on sports? I guess it would have been, uh, was it 2023? University of Washington? I don't remember. No, I did last year. Basically, and then as soon as the big beautiful bill was passed, I said, I'm out. I'm not betting. So when was that? May of last year? Around this time last year, I think. May, June. So about a year ago. By fun, I mean 10-leg player prop parlays. No. I've never done that. I don't like parlays. It's just the statistics are against you. That's why the books want you to do a parlay. Because they get better rate of return. The rate of return the books have, off normal sports betting is like, what is it? I think it's like 3.5%. That's what you need to beat. You need an edge. That's what it always used to be. You need an edge beyond 3.5%. So you need 53.5%. Now with the big beautiful bill, it's 63.5. You need to beat, I guess it is. Or the math works out differently somehow, but it's above 60% edge. You need. Anyway, but then on parlays, so the books typically make 3.5%, right? Parlays, you typically make. The books typically make like 40% or something like that. It's crazy how much they make on parlays. So, yeah. I hope you're not doing that. Are you? It's kind of fun and interesting though, but I would never touch it. Okay, so what do we want to use? Is we can do 3 data points. So we tried unscaled. Let's try 0.5, something really big. No, that's too big. We'll do 0.33. We'll do 0.16. Let's do 0.33 and then 0.08, and then we'll see where to go from there. Turn this guy on. Oh, so the magnitude was way higher because I'm using a shorter look back. So shorter look back raises the magnitude. So what about this? Is 0.33 reasonable? It's hard to see what even this is at, but let's try 0.33. That's what makes it so fun. It is fun. But I don't know. I don't do well. I need like hard metrics when I'm sports betting because I'm too emotional and passionate about sports, and then I always bet on the underdogs and I always lose money. So I'll take like stupid underdogs, but it's like a good story. I'm a sucker for that sort of thing, so all right, so this guy's good. Okay, so we'll do 0.33. Yeah, and then I'll do 8%, and then from that 8%, I'll be able to decide, is it more interesting to extend a data point or get a data point in between? Well, that's what actually makes gambling fun in GK, is if you never gamble a meaningful amount. Um, that's how it's fun. I always think that people love to be extreme. They either take the extreme position of, they love gambling and then they go to the casino all the time and lose a bunch of money. Uh, you know, or they take the extreme position of, they say I don't gamble at all. But I think all you have to do is, it's like when you go to the movies, you decide, if you go on a date to the movies, or if you have a family, if you have kids and you go to the movies, that's probably like $80, you know? So you go, oh, we're gonna go have maybe even $100. You say we're gonna go have a fun night at the movies and spend $100. Um, but then, what's the problem with that? I don't remember what I'm saying. It's too hard for me to do too many things at once. Oh, yeah, yeah, yeah. So you spend $100 on a night of fun. Maybe you do that once a week or something if you have a family. So if once a year you go gambling, you could, do a quarter of that amount. $25 times 50 is 1250. 25 times 5 is 125. Yeah, 1250. So if it depends how much money you have, but that's not unreasonable to go spend that amount. But you have to treat it like it's fun at the movies or something. You're throwing the money away and you won't see it again. And outside of that, if you think gambling's fun, then it's a good way to have fun. Same thing with going to like a sports game. Some people go to like spend $500 to go to a sports game. And that's a good drama and stuff. But hey, Sir Night Night, I haven't even gotten to it yet. I'm at a very basic. I'm just trying to look at like how's my current volatility scaler working. And I feel like I need to get a feel for that first. So that's my first thing is oh, and I didn't even add that in. I added it in at the top of my other list. So yeah, this is what I'm on right now. Oh, compare target volatility. Oh yeah, so I want to see, first I'm trying to see, is the scaler working correctly? Wait, target volatility to volatility. Oh yeah, and then compare realized volatility. Compare target volatility. I don't even know what I'm saying here, really. But basically, I'm trying to go through and make sure the volatility scaler at least is working as intended and how it looks. And then see, if I change around the exposure of the portfolio, how does the Sharpe ratio change? And then the mean exposure. And then there's something to conclude from that. If you need low exposure to get a good Sharpe ratio, then you're in trouble, basically. Okay, so, and then I'm going to start implementing the different volatilities. What is it, Chang? Yang Chang. That's what it was. It's in a different PowerPoint. Did this run? Oh yeah, it did. Wait, this was 33%. Oh. So that actually doesn't look too bad. Big drawdowns, but big returns. This doesn't look that bad. Let's see, how periodic are these events? So here, 2016, right before 2016, right before 2018, right after 2020, right here at 2024, right here, start of 25, start of 26. But that might be tariffs. Is that tariffs? No. That's pre-tariffs. And then here. Okay. So really, that doesn't look that bad. I might just want to tolerate more volatility. Oh, I do want to show the exposure level. Okay, so let's set an 8% target. What are these, your picks? What is that? That looks like soccer. Oh no, it's Castle plus 25. Okay, so some golf thing. Wimby plus 21 and a half points. So what does that mean? Plus 21 and a half points. That means Wemby's going to have 21 and a half points, you're betting? So are those all basketball? I don't know basketball that well. But did the Pistons lose? Did the Cavs beat the Pistons? Yeah, so I'm working on this every day, getting ready to paper trade, working on documenting how the volatility scaler works right now. So if you're interested in this, tune in, subscribe. Yeah, you could see my progress on this as I work on it daily. All right, so let's see what we think about this. Yeah, gross exposure is lower. But let's try just cranking it all the way down now. All right, so let's get the Wait a second. That looks really good. Those returns look really good. I don't know, that looks really good to me. This looks really good. Oh, that's because I added the drawdown. But the drawdown scalar is never coming into play. So 1.5, 120. Here we could say the mean's like 0.3. Okay, so we're gonna put in so we want to compare target volatility to exposure relationship between unscaled volatility, volatility target, and exposure level plus target. Oh, target and exposure level plus target versus realized volatility. Realized volatility. Alright, so this one Target volatility exposure. All right, so then we want to compare. Yeah, you could argue that's what I'm doing, but well, you could argue that's what I was doing earlier, but really what I'm doing right now is trying to understand the model. So this scalar's working the best. Now I'm trying to look through and see, why is this scalar working the best, and when I'm changing it around, what's going on. Because when I optimize, I get something that looks roughly like that. And so what's concerning, I didn't put it in here. But what's concerning is that if it's optimizing and finding lowest exposures best, then that's going to be a problem. So I need to look into that. And then I'm also going to, once I finish this, I'm going to try some different methods of estimating the volatility and use those. So I don't know. I could just put those summaries in. Is there anything I really want to look at? So unscaled volatility. Is there anything else to conclude? So if the volatility is 38, what if we just tolerate 38%? Oh, dang it. This is with the drawdown on. So when did I turn on the drawdown scaler? Alright, so let's see how this does. Okay, I have to go to the bathroom again. I'll be right back. Hey, boy. Whoa. Crazy returns. So if volatility was 31%, let's just target that. No, I think that should be reliable. So 38%, what if I make it even higher? So what if I just went ahead with that? Well, hmm. Whoa. So that gives a crazy... Oh, I already saw that. Is it 38% then? 81? Oh, volatility. Yeah, 38%. Oh, I forgot the optimization's still running. Hey, Hike, how are you? What's going on in your world? Um, so Sharp ratios at different exposure levels. I don't know if I'm that interested in that. So linear regression works well for what? What's it work well for? By the way, because there's 6 people watching, subscribe if you think this is interesting, because I work on this every day. And I'm going to start paper trading Tuesday morning. Alright, this guy's thinking... oh. Holy Grail. Okay, cool. Very good, Sir Night Night. Oh, I didn't turn the scaling back on, so it's still it. Gives the same exact result. Going work on a market tomorrow. What's that mean? Oh, yeah. Well, I definitely agree that 80% drawdown is too high. Yeah, so what do we want? What was I gonna... Oh, yeah, Yang Chang. Yang Chang? Volatility estimator. Parkinson. So if I set the target to the mean, it basically scales down starting when it goes above the mean. That seems reasonable. These returns are really high. Oh, that actually looks not so bad. This seems pretty good, like a pretty good just base method for scaling down the exposure. But yeah, I don't know. It's not good on its own. It's not good enough on its own. Linear regression works well as per market volume for VAL and VAW, VAL and VAH. What are those? I do testing for Indian market, so I've been doing paper trading. It's the second month going to complete. And how's it going? What are the metrics on your model? What's your Sharpe ratio? What's your returns? Is it doing well? Have you had to tweak it? Alright, I keep forgetting what I'm doing. Okay. So this guy's done. That guy's done. This guy I'm not doing. Alright, we're on to the Yang Chang volatility estimator. You have a Sharpe ratio of 4.5? That's crazy. What are you trading on? The whole market or like the index or what? So Yang Chang variance is V overnight. So what's V overnight? Okay. So, let's see. Oh, variance. So to get volatility from variance, volatility is variance times 200, the root of variance times 252. Variance O, variance of the overnight jump plus K medium not much, high a return is in between 50 to 60. Wait, what are you talking about? What are these metrics you're talking about? 50 to 60 what? And um yeah, 50 to 60 what? Sharp ratio? It can't be sharp ratio. You're trading on the stock index. Volume area low and volume area high. What does that mean? Notice in the master formula that we add the overnight variance, but we add a constant K to blend the open to close variance and the Rogers-Satchel variance. K is a statistical weighting constant. They ran complex calculus to figure out exactly how to weight the variables. Okay, let's look up. They must have a paper, right? Volatility. Let's see what they say about it. Oh no, that's not it. Yang Chang. Yang Chang. Yeah, there's no paper on it. That's so outdated. Some Python script that automates it. The AI just automated it in a few seconds. Volume or low, which give a lower area of trade is happening and has occurred a high variance. We could see after if we find the lowest volume area. I don't know what any of that means. Is that your strategy? That's the strategy you're using? No, why did it print like this? wonder if they have a table where they give K. Which one's this? What do you call this? Is it an estimator? It's exactly what it is. Yang and Chang. 2000. Drift independent volatility estimation. Based on high, low, open, and close prices. Good night, Hike. Have a good rest of your night. Okay, so there's their equation for K. Now let's get their other equation. So K is going into an equation, which is, there's our K. This equation. So let's put that in. Hey, Sir Night Night. Volume profile trader. Well, you know what that is then? Okay, so let's look at the code it gave. Yeah, okay. It is my understanding that my volatility scaler does not Okay, that's going to be it for now. I'm going to keep working on this later. Don't forget to subscribe because I work on this every day and I'm going to start paper trading Tuesday morning. And that's about it. Have a good rest of your day. Adios.